Welcome from me, Guy Monson, to our regular 6-minute strategy. Together with my colleague Dr. Subitha Subramaniam, we will be looking at why debt levels are still rising and the challenges governments face in bringing borrowing back to its pre-pandemic trajectory. According to the April report from the IMF, global debt levels are a full 9% above their pre-pandemic rate and have reached 93% of global GDP, a level inconceivable just a few years ago. Indeed, only half the world's economies actually tightened fiscal policy last year, even as revenues from higher inflation are dwindling and receipts from central bank QE programs have reversed. Adding to all of these budgetary challenges is, of course, the political backdrop this year, where more than half the world's populations are headed to the polls. History shows that governments tend to spend more in election years, on average 0.4% of GDP on IMF forecasts. In response, bond markets are already balking at looser fiscal policy promised in next week's French parliamentary elections, while yields are also rising in Brazil as investors challenge President Lula's looser fiscal stance. In all of this, the memory of Liz Truss's mini-budget debacle of September 22 are fresh in investors' minds. In the slides ahead, we will look at the scale of the debt build-up and assess the risks of the bond market vigilantes returning once again, even to the US market. So Subitha, lovely to have you back on 6-Minute Strategy. And we've got your favourite topic today, the burgeoning US budget deficit, and particularly in red, those interest rate payments. And what's the position today?
So we had some unfortunate news from the Congressional Budget Office just this past month, where its projections for the US fiscal deficit for 2024 is now 30% higher than what it put out in February. It's now $2 trillion, or 7% of GDP, which is really unusual because to run such a large deficit when your economy is growing so strongly really leads to some weird and perverse outcomes. You have the deficit then pushing up growth,
yes,
pushing up inflation, pushing up interest rates, and therefore pushing up the interest cost for the government, which then pushes up the fiscal deficit. So you can see from this chart here where this Congressional Budget Office now projects out over the next decade that you're going to expect a fiscal deficit of about 6% in the US, which will be comprised of 3% of interest payments and 3% of the deficit excluding interest payments.
And for most of your and my investing life, 3% was the number we talked about, now possibly at 6%. So let's look at the other side of this, the deficits that are building up and the debt with it. So this is US debt to GDP levels. We've seen them on this programme before, spiking up above the levels immediately after the World War II in 1948 to more than 100% of GDP and rising. Presumably only America could really get away with this.
Yes, so I think the US enjoys exorbitant privilege. It borrows in international capital markets at exceptionally attractive rates. It's, no other country can have a debt to GDP ratio of 100%, a deficit of 7%, and borrow at 4%. It's just very exceptional. And it's the largest economy, it's dominant, it can do so.
Yes.
But one day, there will be a time, we don't know when, at some point there will be some element of discipline exerted by the markets to bring this debt into a more sustainable level.
So what you're basically saying is if the Americans want a $100 bill, they print one. If you and I want one, we've got to deliver the goods in kind to get the note. So that exorbitant privilege for now, but don't ignore the risk. There's another country that's struggling for very different reasons, adding to this debt picture in red there. That's China. The IMF really hauled them out on this. What's going on there?
So China is struggling with the property market that's really deflating, and the government is really trying to prop this up. It's taking on some of the debt levels of the property developers, so that's pushing up its debt levels. It's also at the same time slowing. Its growth trajectory slowing as the population is aging. It has a lot of demographic challenges itself. And so you have sort of a situation where China is slowing. It's not an inflationary debt buildup, but more a deflationary debt buildup, yes, and a balance sheet problem, which is something Japan struggled with in the 1990s.
So we've got two things to watch, and if that wasn't enough, we've also got some big spending priorities, which I think society generally across this whole voter base are going to be demanding. We've shown them there for the priorities for spending for advanced economies. Talk us through them.
So we've talked about the interest payments, which
That's
are
the green bar.
the green bars. And then in addition, we have aging populations. So we have pension and healthcare costs that are starting to come through, which are the yellow bars. We have defense, which is really in response to a volatile geopolitical world, which is the red bars. We have climate, which we do need to address, which is the purple bars. And then, of course, the industrial policy, again, in response to improving security.
And of course, for the developed world, those huge grey bars are the sort of long-term societal improvements which the UN would like to see built into these economies. So that's probably transfers to the emerging world. Gosh, it's quite a shopping list. So what are markets going to say about it? Well, the bond vigilantes are already back. They hounded Truss out of office when that mini-budget came in September 2022, and they're back gunning for Macron. You can see on that right-hand level there the spread of French government bonds to German government bonds, which is widened to 70 to 80 basis points. Now, it's nothing like as bad as it was in the euro crisis. It was over 200. But this split parliamentary picture, you can see in the polls on the left there, with the National Rally, that's Le Pen, and the New Popular Front, that's the left-wing parties, both pushing for big increases in public spending, and the bond markets don't like it. So I think the first thing you as an investor can do is try to go where you know the flow of funds towards bonds is strong. Ironically, that might now be the UK. Starmer's programmes are relatively well costed, and of course we have these huge pension fund surpluses, which are natural buyers of bonds. The second thing you can do is insure in a really deeper way against failure somewhere in the US market, and that probably means using gold. You've always been interested in this as an asset class, Subitha. Just conclude.
So I think gold has really emerged from the pandemic as a safe haven. It provides protection against inflation, against fiscal deficits blowing out, and guards against the bond vigilantes. So it really provides an element of security in portfolios. The other thing is there has really now emerged on the scene. Emerging markets are starting to buy, emerging market central banks are starting to increase their reserves and allocation to gold because they're really worried about the security of their reserves after Russia's reserves were confiscated by the G7. So I think there's a natural buyer for gold looking ahead.
Good. So let's wrap up. I'm afraid that's a whistle-stop tour through global debt levels. Watch for this continued expansion. Watch the bond market vigilantes. Build in some insurance, and think that even the mighty US Treasury market might one day be challenged. Thank you, Subitha.
Thank you, Guy.
Thank you.